Let's run through the attributes, some key components of a general partnership. Now, 2 or more people are required to form a general partnership. We need those 2 people or more to operate the business together. A written agreement is not required to form a general partnership, but it is recommended if the partnership is intended to last more than 1 year. You'll see that a lot. This sort of concept goes into business law as well, where even if something is not requiring a written agreement or written paperwork, if something's intended to last more than a year, whether it's a partnership or some sort of contract or an agency relationship, you're generally going to want to get that in writing. Now, for filing, there's no need to file any paperwork in order to create this general partnership, although some states may require registration of the business name or any licenses and permits, which that totally makes sense. For each partner in a general partnership, you are going to have unlimited personal liability. That's not too fun, not ideal, but that's the business you're getting into. This will also have flow-through income, so the profits and losses of the business are reported on each partner's individual income tax return. What are some pros to a general partnership? Well, all partners in a general partnership have the right to manage the business directly, and absent an agreement to the contrary, all partners have equal rights to manage the partnership. So a limited partnership, you do have a limited liability, but you cannot manage things. When you are in a GP, you have direct management. These rights and voting power are not determined by contribution amount. They are going to be determined by your partnership agreement. Transfer of ownership. Partners cannot transfer their ownership in the partnership without the unanimous consent of the other partners. Profit sharing, unless otherwise agreed. Profits in a general partnership are going to be shared equally among the partners. Why is that important? Well, a question could straight up tell you, okay, this partner gets 40% of the profits and losses. This partner gets 60%. But if there is nothing to indicate that in a question, these are the rules that you will follow. Losses, same way as profits. Disassociation, a partner can withdraw from the partnership. Now, how do you disassociate from it? You can withdraw from the partnership, just get out of there. You can just die. You can become bankrupt, or you can be expelled from the partnership. So those are the ways that you can become disassociated with the partnership. What about apparent authority? This comes up in agency law as well. So nice little introduction to that. A partner in a general partnership has the authority to bind the partnership to contracts and agreements, and this authority will continue until notice is given to third parties. Let's use a nice classic example. We've got a accounting firm that is a partnership, and let's say you've got a partner at the accounting firm. They're going to run around and they are going to sign documents. They're going to make new deals and contracts with entities. They're going to sign up new audit partners, new tax clients, new audit advisory clients, everything like that. And as far as anyone knows, that is what they can continue to do. However, if that partner is booted out, if they sell their partnership interest, it's critical that the partnership starts notifying all third parties and notifies everyone, hey, this partner is no longer associated with us, so this person's not going to be able to sign contracts. However, if that notice is not given to third parties, for all intents and purposes, this partner can continue to bind the partnership to any deals or any sort of contracts that they sign, taking on new debt. Now, would that also result in separate lawsuits for that partner? Yes, it would, but that's how our legal structure works. You're going to need to give notice to third parties once someone is booted out of that agency relationship. Liability for new debts. If a partner disassociates from the partnership, they can be held liable for new debts incurred by the partnership for up to 2 years if notice is not given to third parties. So again, it's just kind of a big deal. Make sure you give notice when you're trying to get the heck out of there, or when you're trying to give someone the boot. Just the proper way to do things. Dissolution. A GP can be dissolved if a partner gives notice of withdrawal, if all partners agree to dissolve the partnership, or by a court order. So that's how the overall partnership can be dissolved, rather than just one partner disassociating from the partnership. That is our overall structure for GPs. Let's keep running through and continuing on. We've got an example here. Let's consider a general partnership that consists of 3 partners. We got Alice, Bob, and Carol, and they are involved in a lot of things, specifically because ABC, nice way to have some common names going in with that. Partnership agreement does not specify any alternate arrangement for profit or loss sharing, and as such, we see the rule here. So the default rule of equal sharing will apply. Now here, we're going to see how do you share the profits and losses. Pretty straightforward, right? Split equally. Suppose the partnership here earns $90,000 in a fiscal year. As per the default rule, the profits will be shared equally among the partners, and the distribution is, well, 90,000 divided by 3. Each partner will receive $30,000 as their share of profits. One thing I will note, whether it's shareholders, partners, any sort of owners of a legal entity. Lots of questions will try to trick you into getting it confused. Are we talking about a total amount for the entity, or is it per owner? So for example, this question may say, suppose partnership earns a profit of $90,000 per partner in a fiscal year. Obviously, that's incredibly different than saying it earned $90,000 in total for the fiscal year. That could really mess you up on some Sims multiple choice questions. So just like if I were to say on bond questions for the financial exam, always pay attention to dates. Depreciation questions, always pay attention to dates. Those are common ways they'll trip you up, because then you'll mess up your depreciation calculation, your interest expense calculation. So too for this, you should be always on the look for, are we talking about the partnership's total amount or a partner's total amount? Loss sharing example, same thing. $45,000 loss here, divide that equally 333. Each partner will have a loss of $15,000. Now, in both of these cases, the profits and losses are going to be shared equally among the partners, as there is no specific agreement to the contrary. Partners may choose to include a different profit or loss sharing arrangement in their agreement, which can be based on their capital contributions, any specific roles in the partnerships, or any other agreed upon formula. This exam is going to very much try to trick you, for sure. Do not let yourself get tripped up. All right, so we talked about what happens when partners receive their share of income and losses. Let's talk about what happens if in a partnership, a partner can't cover their share of the loss. That's not good. Now we're going to see the pro rata basis for covering a partner's share of losses. If a partner is unable to contribute their share of losses due to bankruptcy or they refuse, you may see that in a question. Partner refused to share in their portion of the losses. The remaining partners must cover that share on a pro rata basis. Now, pro rata, this is something we see throughout all the exams, kind of just that concept of dividing it up percentage-wise. This means that each remaining partner will contribute to cover the share of losses based on their proportionate share of the total remaining partner's interest. So in other words, the partner is going to adjust their shares to account for the non-contributing partner, and then they're going to bear the losses equally among themselves. And if all of that was mumbo jumbo to you, here's a nice example with some numbers. Now, for example, let's consider a partnership. We've got Alice, Bob, and Carol back again to save us through a nice example. They're going to incur a loss of $60,000, which should be equally shared among them. Now, again, it says they incur a loss of $60,000, not they incur a loss of $60,000 each. Again, keeping that in mind, the exam is going to always try to trick you with that. Now, we've got a $20,000 loss for each partner. However, Carol's going to be unable to contribute her share due to bankruptcy. Now, in this case, so it all ties together, right? We talked about how a partner could be disassociated from the partnership due to bankruptcy. Now we see that happen. Carol, she gets the boot. She's kind of gone. Now, Alice and Bob are going to have to cover Carol's share on a pro rata basis. So how is that loss allocated among the remaining partners? The total loss of $60,000 is now divided up between Alice and Bob, with each partner bearing a loss. So they initially each had $20,000 of that loss, and then they divide up Carol's $10,000 loss. That's important because how does that flow through to their own individual tax returns? Concept like this, make sure you know it, make sure you're familiar on how to answer a question like this if you were to see it. Now, it's essential to remember the default rules while answering questions about profit and loss sharing for partnerships overall. That's, again, critically important because the questions could give you a different, custom, unique profit and loss sharing arrangement, or it could not give you that, in which case you have to remember, how are we going to allocate everything? The capital, how are we going to allocate the profits, losses, anything like that, any excess liabilities, lots of different wonderful questions they will ask you. Now, let's form that general partnership. What are the things necessary to form a general partnership? Well, as we said, it's two or more people who have an agreement, be it express or implied. It can be in writing, or it can be implied if me and someone else start working together on some business activity, then that's generally going to be considered a partnership. And to carry on a business for profit as co-owners, again, that's kind of just the rule. We're not really doing a not-for-profit instance here. As such, with all of those things, no paperwork is going to be needed, nor filings with the state needed. We got an example here of a general partnership that could involve two friends. We've got Alice and Bob. Looks like Carol did not recover from that last bankruptcy she saw. They decided to start a small bakery business. Alice is going to be a skilled baker, and Bob has experience in marketing and sales. They agree verbally to work together and share the profits and losses of the business. They find a location, purchase equipment, and start selling baked goods to the public. Now, in this scenario, Alice and Bob have created a general partnership based on their verbal agreement to carry on the business for profit as co-owners. They did not need to file paperwork or register with the state, as their partnership is implied by their actions and their mutual understanding. However, it is important to note that a written partnership agreement is still recommended to clarify the terms of their partnership and help to avoid potential disputes in the future. Now, all this is important, and why is that? You can see a multiple choice question, and it talks about Alice and Bob wanting to form a partnership. And the possible answer choices could involve, that they need to file paperwork, that it needs to be in writing, that it needs to have 3 people instead of 2 people. So all of these attributes, criteria, requirements, things about partnerships, make sure you know them, because it could say, is this a legitimate partnership? Is this a different type of business entity? What do they need to do to solidify the partnership? All of those questions could be properly asked here. And again, is it okay? Is this a legitimate partnership? Or is this another type of entity? Make sure you are familiar with all of them. You're doing great. Sure, you're doing great. Hey, you're with us. So right away off the bat, you're doing wonderful. All right, some more characteristics of that general partnership, because we will see general partners working together with limited partners. And we've seen those in comparison with each other, understanding the differences between those. My background in the asset wealth management space, you see a lot of general partners, which generally you could say the management company. They're the ones making the investment decisions. The limited partners, those you could think of as kind of the Harvard Endowment Fund or the Alaska Firefighters Pension Fund. And those are LPs and they're invested kind of like shareholders, but this is a little partnership. And not to get into the whole realm of the investment management space, it is incredibly complex and a little too complex, but hey, that's life. General partnerships operate based on majority decisions for ordinary business matters. So again, they're the ones doing the shop. So we've got XYZ hedge fund. They're the ones they're the GP. They're making decisions for what's being traded, what are the activities that all the LPs are invested in here. They're also invested as well. They make decisions for these business matters and unanimous consent for extraordinary matters. Partners are going to act as agents of the partnership, and their actions within the ordinary course of business can bind the partnership through apparent authority. We talked about that as well. Now we've got actual and apparent authority. These are concepts we will beat to death in our agency law topic, but generally speaking, actual authority, it's written in writing, and it says that this partner can bind us into contracts solely dealing with raising money through debt. They can't do anything else, bind us into revenue contracts. They can't bind us into any other sort of contract. However, if the industry standard is that these general partners usually can bind the partnership into any sort of contract, then that's apparent authority. It seems apparent that they are able to do that. And as such, a reasonable person, and if any of you studied law in the past, you know that phrase, what would a reasonable person do? The running joke being, hey, where are we ever going to find this reasonable person that you keep mentioning? Does that person exist? In our world, probably not. But what would a reasonable person think that this individual, this general partner, has the ability to do? So if I walk into a Kohl's or a Macy's trying to buy some clothes, I walk up to the cashier, I say, hey, can you look in the back for my size of that shirt? I believe that they have the authority to do that. I believe that once they get the shirt from the back, they can accept my cash for it and I can buy it from them. Now, if they don't have that authority because maybe they're on probation, right? The company doesn't want them handling the money. Well, as the customer, I don't know that. That's not something I would inherently know. So I saw that they had the apparent authority to take my money, give me a shirt, send me on my merry way. But again, maybe that was just a random person who walked behind the counter and pretended to work there. That's on Macy's or whatever it is, the store, to make sure that that does not happen. That's actual and apparent authority in a nutshell. We'll beat that to death again in agency law, but important to see here. And that's why I do recommend you go through all of our material once, come back through it again, because there are concepts that just we have to introduce at varying points because it all is intertwined with each other. Now here we've got decision making in a partnership for matters within the ordinary course of the partnership's business. Decisions can be made by a majority vote unless the partnership agreement states otherwise. So we've got the general partner, we've got a few other limited partners. They're all in cahoots together. They're doing business. They are, let's say, raising money. They're going to start a amusement park. Generally, you're going to see investment management, asset wealth management do big things like that. Shipping, oil rigs, things that take lots of capital. So ordinary course of business, majority vote, something like that. We'd say, we want to expand our amusement park. For matters outside the ordinary course of business, unanimous consent of all partners is required. So if we want to radically change and move into a new industry that is outside the ordinary course of business, examples of these matters are going to include admitting new partners, confessing a judgment, or submitting a claim to arbitration. So, admitting guilt in a court of law. and making fundamental changes to the partnership's business, like selling the partnership. Yeah, I mean, that would be pretty much outside the ordinary course of business for sure. Talking more about agency relationship in a partnership. Now, in a general partnership, every partner acts as an agent of the partnership, and the partnership is their principal, as we've mentioned. This means that the actions of each partner can bind the partnership legally and financially. Now, if a partner acts within the ordinary course of business, the partnership will be bound by their actions through apparent authority, even if the partner did not have the actual authority, just beating that to death, right? This also will double benefit you because you'll see a lot of this when we get into agency law. Now, if a partner does act without actual or apparent authority, the partnership can still become bound to the transaction if it knows the material facts and assents to the transaction. Assent can be expressed explicitly or implied by accepting the benefits of the transaction, and that's something, again, agency law. We're gonna get into that very well in depth indeed. All right, what are the rights of partners over partnership property? Great question. So I could be a shareholder of Apple, but even a significant shareholder of Apple. But does that mean I can just walk right into the Apple warehouse and start taking newly built iPhones off the shelves, off the manufacturing line, and just put them in my pocket? Nope, not at all. Now, similarly, what are the rights of partners over the property owned by their legal entity? Well, partners in a partnership do not have individual ownership over partnership property. They're only allowed to use the property for the benefit of the partnership, not for personal gains. Now, for instance, Carla and David, they decided to start a restaurant partnership. Now, Carla is going to contribute her commercial property while David contributes restaurant equipment. Once this legal entity, this partnership is formed, Carla cannot rent out the property to someone else for her personal benefit, and David cannot use the restaurant equipment for his own catering business. If they want to do that, they'd have to agree to make a distribution from the partnership of those assets to the owners again, so then it would belong to those individual owners. Both the property and equipment are going to be partnership property and can only be used for the partnership's purposes. Now, next up, in another example, we got Emily and Frank. They form a partnership to run a software development company. Emily's going to contribute office space and computers, while Frank contributes $100,000 in cash. Emily cannot use the office space for her personal events, and Frank cannot withdraw the $100,000 for his personal expenses. Now, the office space, computers, and cash will be considered partnership property and can only be used for the purposes of the partnership. Sounds good to me. Nothing too wild there, nothing too crazy. You got this. All right, the rights of the partners in the partnership interest. Now, a partner's interest in a partnership includes the right to receive a share of the partner's profits and surplus. So this is your partner's interest. This is essentially your ownership. Kind of think of it like your shares in it, but shares don't exist because we're not talking about a corporation here. A partner can assign their interest to someone else, but the assignee does not automatically become a partner with management rights. So we'll see. That's an interesting situation there. George is a partner in a retail business with Helen and Ian. He decides to sell his partnership interest to a friend, Jack, and that's just a separate deal with Jack. That's just, maybe he owes Jack money and he says, hey, I'll just assign you the profits and losses from my partnership to you instead of having to worry about paying you. It's just a situation you may see. Don't overthink it too much. Jack is entitled to receive George's share of the partnership's profits, but this person is not automatically a partner in the business. Jack cannot attend partnership meetings, inspect the books and records, or vote on decisions unless the other partners, Helen and Ian, agree to admit him as a partner. You can't just kind of back end do this and make someone a partner. Remember, that is a big, significant change that needs to be voted on. It's out of the ordinary course of business. We're going to continue diving into liabilities for partners, liabilities being quite the important topic for partnerships overall. As we get into our partnership lessons, we'll see the impact of liabilities, monetarily, calculation-based, 4 questions. Here, we're diving into general partners, liabilities for them. We're going to see that they have joint and several liabilities, meaning that they could be held responsible for the entire amount of any debts or liabilities that are incurred by the partnership. Talking about general partners, talking about recourse liabilities, bringing that all together. Now we're dealing kind of more with contracts and torts, which you'll be quite adept at that when you see business law. What is personal liability? Well, each partner has personally and individually liable for the entire amount of any obligations, including contracts entered into and torts committed by other partners within the scope of the partnership business, or if they are otherwise authorized. So essentially, kind of like agency law, within this, if an action is taken kind of in the ordinary course of business within the scope of the partnership, then you too could be held liable. Even though you may not have been the one to commit the action, if another partner took an action that was within the normal scope of the partnership, you may be liable for that. Joint and several liability, well, this concept means that each partner can be held responsible for the entire amount of a partnership obligation, regardless of their individual share or involvement. So, kind of building on point one, creditors can pursue any of the partners for the full amount of the debt or liability, even if one or more partners had no direct involvement in the activity that led to the obligation. So yeah, lots of risks as we're seeing here. Maybe think twice about opening up a partnership or getting involved as a GP. What about the partnership assets? Well, in many states, before a creditor can pursue an individual partner's assets to satisfy a judgment, they must first exhaust the assets of the partnership. This means that the partnership's assets must be used to pay off the debt or liability before the personal assets of any partner can be targeted. Lastly, here, naming partners in a lawsuit. Additionally, in many states, a creditor cannot satisfy a judgment against an individual partner unless that partner was named as a defendant in the lawsuit. This means that if a partner was not specifically named in the legal action, their personal assets may be protected from being used to satisfy the judgment. Just some different attributes and key points to know about all of this. Now, it's important to note that these rules apply to general partnerships where all partners have unlimited liability. In LPs or LLPs, the liability of partners may be limited based on their role in the partnership and the partnership structure. All right, let's compare partners here. Let's see what we got. Well, in a GP, the default rule is that partners are not entitled to receive compensation for services rendered to the partnership. So this means that by default, partners are not paid a salary or wage for their work in the partnership. However, instead, they share in the profits and losses generated by the partnership. The underlying assumption here is that partners are motivated to work for the partnership because they have a stake in the success and they will be rewarded through their share of profits. However, partners can agree otherwise in their partnership agreement, specifying different compensation structures for the services they provide to the partnership. We're going to talk about, just throughout partnerships, the concept of a guaranteed payment, kind of essentially the same thing as a salary or a wage, but it's paid to a partner. Just classification purposes, treating it a little bit differently than just salaries and wages. Now here, let's assume that Alice, Bob, and Carol form a general partnership to operate a marketing agency. They do not have a partnership agreement specifying any compensation for their work in the partnership, and as a result, they are subject to the default rule, which states that partners are not entitled to compensation for their services. Alice is going to work as a graphic designer, Bob is a copywriter, and Carol is an account manager. They invest their time and skills in the partnership and successfully complete several projects for clients. At the end of the year, the partnership will generate a profit of $120,000. Good for them. Sounds like they're doing pretty well. Now, since the default rule applies here, Alice, Bob, and Carol do not receive any separate compensation for their services rendered to the partnership. Instead, they're going to share their profits equally as per the default rule for profit sharing. Each partner is going to receive $40,000, which is 120 divided by 3, as their share of the profits. Now, if Alice, Bob, and Carol had agreed otherwise in the partnership agreement, they could have specified a compensation structure, which could be a fixed salary or an hourly rate for their services rendered to the partnership, in addition to their share of the profits or in place of profit sharing. Some other situations dealing with partnerships, creditors and charging orders. Well, creditors of an individual partner can obtain a charging order against that partner's share of the partnership's profits, but does not grant the creditor any management rights in the partnership. Kind of the same thing if you assign your partnership interest to someone else, their rights of the profits, that will go to someone else. But again, a creditor is kind of like garnishing wages. If you're not paying your bills, they can come after your partnership interest, but that doesn't make them a partner. Now here in this example, Laura owes money to a creditor, let's say a bank or something like that, and she is also a partner in a real estate investment partnership with Mark and Nancy. Now the creditor, again, such as think of like a bank, can obtain a charging order against Laura's share of the partnership's profits, but the creditor cannot take over Laura's role in managing the partnership or gain access to the partnership's books and records. Again, remember that's an incredibly important big change out of the ordinary course of business, so that would have to be voted on. Maybe Mark and Nancy want this bank to be a partner. Well, not that a bank as a legal entity could probably be a partner, but we'll talk about that later. But yeah, if this is an individual and Mark and Nancy want this new person, they can vote this new person in. Deceased partner's share of profits. Well, when a partner dies, their right to profits passes on to their heirs, while their right to partnership property vests in the surviving partners. This is something that's probably written into the will and dealing with estate and inheritance transactions that we will see. Olivia and Paul are partners in a law firm. Now, when Olivia dies, her rights to profits from the partnership is transferred to her heirs. Again, however she allocated those to her heirs, she would have written something up, especially, I would think, being in a law firm, she probably would know to do that. However, Olivia's right to partnership property, such as office furniture or equipment, passes on to the surviving partner, which is Paul. Which makes sense. Paul's using this, and if Olivia's heirs tried to take their grubby little hands and get the office furniture or equipment, then Paul might not be able to continue on, and that's not really fair to Paul or the other continuing partners if there were other ones. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.